In this series of videos, we're going to talk about the financial statements. In our first video, we're just going to go over some accounting terminology. So if all those terms on the screen, asset, liability, shareholders equity, revenues, expenses, and dividends, if they're all familiar to you, maybe skip ahead to the next video. But I do think that you really need to understand these terms before you do anything in accounting. There's not a ton of jargon in accounting, but these are like the cornerstones to your understanding what accounting is and understanding how to do it. So let's start with the first one. Let's start with assets. What is an asset? I suspect everybody watching this video has an idea of what an asset is if you understand English well, because you've probably heard the term asset thrown around. And the colloquial or the normal definition of asset is a good one, and it pretty much holds in accounting as well. So an asset, in terms of a formal accounting definition, is any resource that a company owns or controls that produces a future economic benefit. So any resource a company owns or controls that produces a future economic benefit. That's a great definition. I want to even simplify. If you're taking an introductory course, I just want you to think of, when you think of assets, think of the stuff that the company owns that a company should want to own. Yes, I know there's control is also in the definition, but I think we get into issues of items we control but don't own in more intermediate and advanced accounting classes. At an introductory level, just think of it as the good stuff a company owns that, a company can own. So looking around this room, I'm talking to you on a computer. My computer is an asset of mine. I own it. I control it. I could sell it. I could do what I want with that computer. You can see behind me is a kitchen table. That's the same. Where in my house, it's my kitchen table. I own it. I control it. These are some of my assets. I'm in a house that I also own, so that is my asset. Liability is the flip side of assets. Liability are future obligations of a company. And again, that's the textbook definition. So it's future obligations or encumbrances of a company. I again like to simplify here. When I think asset, I think anything we own that's good to own. When I think liability, I think owe. Owe is the word that comes to mind. It's something that we have to pay back either with money or by delivering a product or service, but typically with money. So when I think of liabilities, I think of two broad categories in my own life. I think of my phone bill. So I receive a phone bill. I've used my phone for a month. I get a phone bill from the phone company saying, hey, you got to pay us $75. And if I haven't paid it yet, it represents a liability to me. It's something I'm going to have to pay. Once I've paid it, it's no longer a liability. The other one that's in my life is my mortgage, right? I mentioned I have a house. I don't own it completely. I have a mortgage on this house, and that's a big debt. That's something I owe that I'm going to need to pay back. So my phone bill, in accounting terminology, we would call that an account payable. My mortgage would be either a mortgage payable or a bank loan payable or even a note payable. But those are all types of liabilities. Moving on to number 3, shareholders equity. This is the first one where I think, look, if you have a good command of the English language, you may not understand shareholders equity. Probably you had a good idea about liability. I think definitely you would have had a good idea about what an asset is. But when we get down to shareholders equity, I think this is the first place where there's going to be significant confusion. So let's touch on shareholders equity a little bit more. The definition, the textbook definition, they say it's the residual value when you deduct liabilities from assets. That's the textbook definition. Pretty meaningless to me. But actually, if you put it in an example, it makes total sense. So I've talked about this. It's a townhouse that I live in, and I bought it a few years ago for $300,000. So, and trust me, $300,000 does not buy you a phenomenally huge place here in Kamloops. But anyway, I'm not bragging is what I'm trying to say. So I have this asset, right? I have this townhouse worth $300,000. Now, when I bought the townhouse, I did not have $300,000 cash. I've never had $300,000 cash. I couldn't pay the full amount. So I did what most home buyers do. I got a mortgage, and the mortgage was for $250,000. $50,000. So I have a liability related to that asset of $250K. So I'm going to explain shareholders' equity by explaining the concept of home equity. So if I have an asset of 300 and the liability associated with that asset is 250, well, let's think of it a different way. If I were to sell my house for exactly $300,000, and of course, when I sell my house, the bank who has my mortgage issuer, would absolutely collect their $250 out of that $300,000 proceeds. So how much money goes in my pocket? What is my piece of the pie? My piece of the pie is my equity in my house or in a company. It's the shareholders' equity, and it's $50,000. So shareholders' equity is the owner of a company's piece of the pie. The shareholders are the owners of a company. Their equity in the company is their piece of the company. So again, I have a $300,000 house, a $250,000 mortgage. If I were to sell the house tomorrow for $300,000, pay off the mortgage, how much money goes in my pocket? Well, that's my equity. And there's this formula in accounting. It's a beautiful formula. It's called the accounting equation, and it's the cornerstone of a lot of what we're going to do. The formula is assets equals liabilities plus shareholders' equity. And that formula is really at the cornerstone of what we're talking about. So again, let's quickly go over those three terms again, because they're just everywhere in accounting. You need to know them. Asset, the things a company owns or controls that provide a future economic benefit for the company. So again, they own it, they control it, and it's going to give the company a future economic benefit. Again, it's the stuff a company owns and controls that they should want to own and or control. Liability, anything the company owes. These are the future obligations of a company, something the company's got to pay back. 99% of the time it's cash. Like when I got my phone bill for $75, the phone company wants $75 cash. They don't want me to show up at TELUS, which is the name of my phone company, and start raking leaves and saying, well, I'm paying you back with my leaf raking. No, they want cash. 99% of companies' liabilities are cash to be paid back. There are times where, though, you might have an obligation to rake the leaves. We call that an unearned revenue, and we'll talk about that in Module 3. Shareholders' equity is what's left over when you sell off all your assets. Let's assume the value is their cash value. You pay off your liabilities. What's the shareholders' piece of the pie? What's going in the shareholders' pocket? What percentage of this company does the shareholder own? And maybe selling off is the wrong way. I like to illustrate it that way, but if you just think about my house, it's a $300,000 house with a $250,000 mortgage. I guess you could say, how much do I, the homeowner, own, and how much does the bank own? We have this $300,000 asset. I own $50,000. The bank owns $250,000 of this house. Maybe that's a better way of looking at it. Okay, 3 more terms we're going to zip through here. Revenues. Revenues, when I think revenues, I think one word. I think earn. So when you think revenues, you think earn. It's the company doing what it does to earn money. How does this company earn money? So when I go to Walmart, the biggest retailer in the world, Walmart sells me things. Walmart has sales revenue. When you pay, if you're at a university and you pay tuition dollars, your university has tuition revenue. They also most have government grant revenue, right? Governments fund them and your tuition dollars don't completely fund them. But where is the company's money coming from? Well, that's the revenue side. What is this company doing to make money? My wife has a rental property. She derives rental revenue from that, right? Whatever the company's doing to earn money, well, that is what a revenue is. Expenses are the costs of earning that money. So I'll give you a few examples of expenses in my university. So my university, again, gets tuition revenue and grant revenue, but they have lots of costs. There's tons of costs running a university. The first one that comes to mind is they got to pay me. Like, I like my job. I enjoy being a professor at a university, but I'm not doing it for free. You know, if those paychecks stop coming, I'm going to stop showing up to work. So the wage that they pay me, their salary expense is a cost of running a university. They have these beautiful buildings with beautiful gardens around them, and they have people mowing the lawns. Well, keeping the gardens green, the salary and wages of the people that do maintenance at a university, the supplies that go into, fertilizing the grass. I'm in Kamloops. It's a desert environment. The grass would be brown, but our grass is all beautiful and green. Those are all costs of running a university. Building upkeep. There's tons and tons. You could just imagine the myriad of costs that go into running a large university, but you could also imagine it on a small company, paying the phone bill or paying wages to an employee or two. It doesn't have to be hundreds or thousands like a university, just one or two employees. Well, those are the costs of running a business. The last one, and I'll be very quick here, is dividends are when a shareholder chooses to take money from the company. I'm thinking of this as a company where there's just one or two shareholders and they decide, look, we'd like to take some money out of the company. They choose not to pay themselves a salary. They can choose to take a dividend. And a dividend is just the shareholder saying, look, we've had lots of revenues. We've had fewer expenses. We made a big profit. We'd like to take money out of the company. A dividend is the shareholder taking money out of their company. I categorize that separately. Some profs might consider dividend just to be a part of shareholders' equity, but I like to treat it as its own animal. Okay, so assets, liabilities, shareholders' equity, revenues, expenses, and dividends. I hope those terms were all clear. I'm going to just zip through them one last time. Asset, things a company owns or controls that provide a future economic benefit, but again, things a company owns that they should want to own is what you should be thinking of in intro accounting. Liability, anything the company owes, the future obligations of a company, but think of it as the company owing. Shareholders' equity, what's left for the shareholders if they used all the assets and paid off the liabilities? What's left for the shareholders? What's the shareholders' piece of the pie? Revenues, what the company does to earn money. Expenses, those are costs of doing business, and dividends are when the shareholders choose to withdraw money from their business. That's all for our first video. We're going to do a lot of problem walkthroughs in this module, so stay tuned.